What if I told you that reaching your long-imagined XRP price could come with a problem almost no one is talking about? Picture this clearly. XRP finally makes its long-awaited move. The number you've carried in your head for years lights up your screen, and for a moment, everything feels validated. Then, you try to act, and suddenly selling isn't as simple as you always assumed. The order doesn't fill the way you expected. The liquidity isn't there. The experience feels unfamiliar and unsettling. It sounds extreme, but that exact warning has recently been raised by several respected voices inside the crypto market. And the more I looked into it, the harder it was to ignore. As someone who has watched XRP through multiple cycles, this idea immediately grabbed my attention. Most people prepare emotionally for higher prices, but very few prepare structurally for what happens during those prices. That difference matters more than most realize. Over the years, XRP holders have endured brutal drawdowns, endless waves of FUD, regulatory headlines, and the constant jokes about patience wearing thin. Like many of you, I've always had a mental level where I imagined finally taking a step back, securing part of the win, and breathing a little easier. But what if the next major rally doesn't unfold that cleanly? What if the crypto market behaves very differently when pressure really builds? That question hit harder after a post circulated from Jack Claver, the CEO of Digital Ascension Group. His message wasn't dramatic, but the implications were serious. In simple terms, when XRP experiences explosive price action, many exchanges may not have enough liquidity for retail participants to exit at the prices displayed on the chart. That's a difficult idea to sit with. Years of conviction can collide with a market reality that feels unfair. Even though it isn't malicious, it's structural. The core of the concern is a potential supply shock. Institutions, banks, and large funds don't interact with markets the same way individuals do. They aren't lining up on public exchanges clicking market sell or buy. They move through private, over-the-counter channels, absorbing liquidity quietly while public order books grow thinner. In those conditions, the largest players naturally gain priority access to liquidity, while retail participants compete for what remains. That's not a conspiracy. It's simply how markets function when size and influence enter the equation. This realization forces a shift in perspective. For years, the conversation around XRP has revolved almost entirely around price targets. $5, $10, $20. But price without liquidity is just a number on a screen. If enough people rush to the same exit at once, the market doesn't accommodate everyone politely. It gaps, it slips, and it punishes urgency. The crypto market rewards preparation, not assumptions. Shortly after Claver's comments gained attention, another respected community voice, Diana, highlighted a related issue that often goes overlooked. Most people gravitate toward the same round number sell levels. $10 is the classic example. But if tens of thousands of XRP holders are aiming for that same price, a simple question emerges. Who is actually buying all of that XRP at that level? Markets aren't ticket lines with infinite demand waiting patiently at a specific number. When sell pressure overwhelms buy orders, trades execute wherever liquidity exists, not where hopes are set. That could mean significant slippage, especially if the order book is thin. In that moment, disappointment doesn't come from being wrong about XRP's potential, but from misunderstanding market mechanics. That distinction is critical, and it's where many people lose value without ever seeing it happen. This gap between excitement and execution is where the real risk lives. Most participants focus on charts and price action, while ignoring liquidity, structure, and behavior under stress. XRP, because of its institutional use case and growing role in blockchain-based payment systems, may feel these pressures even more intensely. Institutions don't just trade differently, they change availability itself. And once you start viewing XRP through that lens, the entire conversation begins to shift in a much more serious direction. When large over-the-counter transactions take place, XRP effectively moves out of liquid public markets and into private balance sheets. That XRP isn't sitting on an exchange waiting for the next retail seller to hit the button. It's temporarily removed from circulation. From a long-term perspective, that's constructive. It supports valuation and utility. But in the short term, especially during a sharp rally, it can be brutal for liquidity. Retail traders often need access to that liquidity at the exact moment it's least available. On top of that, recent developments around Ripple's expansion into treasury-focused solutions add another layer of complexity. Corporate treasury systems are designed for usage and efficiency, not speculation. That means XRP being locked into payment flows, enterprise systems, and balance sheets. Again, long-term bullish for the ecosystem, but it tightens the available float on exchanges precisely when retail participants might want flexibility. This is where psychology becomes dangerous. Rising prices create urgency. Urgency fuels emotional decisions. Emotional decisions combined with thin liquidity often result in regret. The irony is uncomfortable. The rally people dream about can become the moment many mishandle their biggest opportunity. That's why I've stopped thinking in terms of one perfect sell price. Markets don't reward simplicity during chaos. They reward preparation. Instead of imagining a single exit, the focus shifts toward layers, options, and contingencies, not because of pessimism, but because realism matters when volatility accelerates. If XRP begins to move aggressively, exchanges will feel the strain. Some platforms will lag, others may freeze temporarily. Withdrawal limits can tighten. Order execution may be throttled quietly in the background. None of this is hypothetical. We've seen it during previous cycles in 2017 and 2021, and again during sudden volatility spikes. Anyone assuming this time will be frictionless hasn't been paying attention. The real shift comes when you understand that holding XRP is only part of the equation. Knowing how to manage exits responsibly, efficiently, and with minimal slippage is the other half, and it's rarely discussed openly. Most people won't think about this until XRP is already vertical, emotions are high, and time feels scarce. That's the worst possible moment to start planning. Mindset plays a central role here. You don't design a fire escape when the building is already burning. You don't learn how to swim when the boat is sinking. And you don't build an exit framework in the middle of a euphoric market. You do it quietly, in advance, before urgency takes over. Once you truly understand how liquidity, institutions, and human behavior collide during major price moves, the crypto market starts to look very different. At that point, the conversation naturally shifts from excitement to execution. Price alone doesn't change outcomes. Execution does. And execution, especially in crypto, is where most people struggle. Not because they were wrong about the asset, but because they underestimated the friction between paper gains and real-world results. One of the biggest misconceptions among retail participants is the belief that liquidity is guaranteed. Under normal conditions, spreads are tight, order books are deep, and selling feels effortless. But those conditions exist precisely because nothing dramatic is happening. During extreme moves, liquidity becomes selective. It flows to size, to relationships, to negotiated deals, not to whoever clicks fastest. This is especially relevant for XRP, given the nature of its future demand. Banks, payment providers, and large institutions don't chase candles. They accumulate strategically, often ahead of visible price action and often off-exchange. By the time retail sees a parabolic chart, much of the meaningful positioning has already occurred elsewhere. That means public markets are reacting, not leading. And when public markets react all at once, they tend to break. Order books thin rapidly. Buy walls disappear faster than expected. The chart may still display a high price, but that price might reflect the last small trade, not a level where meaningful volume can be absorbed. This is where slippage quietly erodes value. It doesn't announce itself. It simply takes from those who didn't plan for it. Another underestimated factor is exchange behavior under stress. Exchanges are businesses first. When volatility spikes and risk increases, internal systems respond. Withdrawals may slow, trading pairs can pause, maintenance issues appear at the worst possible moments. These patterns repeat every cycle. The bigger the move, the higher the chance something goes wrong exactly when everything needs to work. This creates a dangerous feedback loop. Price accelerates. Fear of missing the exit grows. People rush decisions. Systems strain further. Slippage increases. Frustration follows. By the time conditions stabilize, the window many were aiming for has already shifted. That's why I've stopped framing this as simply selling XRP and started thinking in terms of managing liquidity exposure instead. Selling implies a single action. Managing implies a process. A process adapts. A single action can fail. And that distinction becomes critical as markets move faster and complexity increases, especially for assets like XRP that sit at the intersection of retail speculation and institutional infrastructure. One of the most important realizations is that not all XRP needs to be treated the same way. Long-term conviction doesn't require an all-or-nothing approach. You can believe strongly in XRP's future while still recognizing that markets move in waves. Those waves create moments to reduce risk, secure capital, or reposition without abandoning the broader thesis. That nuance is often missing in online discussions, but it matters when liquidity tightens and emotions rise. Personal position size is another factor many underestimate. The larger the position, the harder it becomes to exit cleanly when conditions are thin. Selling a few $1,000s worth is fundamentally different from trying to move 6 or 7 figures. Yet, many people mentally plan exits as if their size doesn't matter. In reality, your size relative to available liquidity is everything. The market doesn't care about your patience or your narrative. It only cares about matching buyers and sellers at that moment. This is where the psychological side becomes critical. During a major rally, everything feels urgent. Social feeds explode, targets escalate daily, rational planning gets drowned out by dopamine. People who swore they would sell at a certain level suddenly convince themselves to wait just a little longer. Others panic far earlier than expected because volatility feels overwhelming. Both outcomes usually stem from the same issue: a lack of a predefined framework. A framework doesn't guarantee perfect outcomes, but it reduces regret. It shifts decisions from reactive to deliberate. Instead of asking what to do in the heat of the moment, you're executing something you already thought through under calmer conditions. That distinction becomes invaluable when price action accelerates and clarity becomes scarce. Another layer that often gets ignored is the bridge between crypto and traditional finance. Selling XRP is only half the journey. Converting it into usable capital introduces a new set of bottlenecks. Banks have compliance thresholds. Transfers can be flagged. Large inflows can trigger reviews. If you've never moved significant sums before, that friction can be surprising and stressful. This is why thinking about exit strategy in isolation is incomplete. The moment XRP turns into fiat, you're operating inside a system with very different rules. Timing matters. Documentation matters. Relationships matter. Ignoring that reality doesn't eliminate the problem. It simply postpones it until it's more disruptive. Then there are taxes, the least exciting but most unavoidable aspect of success. Gains, realized in volatility, are still gains. Fast markets don't remove obligations. People who fail to account for this often end up worse off months later, even after a strong exit. Planning for liquidity without planning for taxes is like fixing the engine while ignoring the brakes. All of this can feel overwhelming, especially for those who have focused primarily on the macro narrative around XRP. Utility, adoption, institutional rails, global payments. Those elements still matter deeply. In fact, they're exactly why these liquidity conversations exist at all. No one worries about exit mechanics for assets going nowhere. The paradox is that the more successful XRP becomes, the more complex the mechanics around it grow. Success attracts size, size changes behavior, behavior reshapes market dynamics. Retail participants who don't evolve with that reality risk becoming spectators during the moment they waited years for. What helped me most was reframing the goal. The goal isn't to perfectly time the top. That's a fantasy. The goal is to walk away from a major move with clarity, capital, and optionality. Optionality creates choices. Choices create control. And control is what most people think price alone provides, even though it doesn't. Another subtle but important shift is recognizing that doing nothing is still a decision. Holding through volatility can be a valid approach, but only if it's intentional. Too many people confuse conviction with inertia. Conviction is active, inertia is passive. One is powerful. The other becomes dangerous when conditions change quickly. As XRP's ecosystem matures, the market will increasingly favor participants over spectators. Participants anticipate friction. Spectators assume smoothness. Markets rarely reward that assumption. None of this implies disaster. It implies increasing complexity. And complexity doesn't punish preparation, it punishes ignorance. The people who navigate the next major move successfully won't necessarily be the loudest or most confident online. They'll be the ones who quietly understood how the system behaves under stress before it started moving fast. Once you begin to see XRP through that lens, the discussion naturally expands beyond charts into something far more practical. Readiness, not hype, but operational readiness. That's where real outcomes start to diverge. That idea of readiness is where everything finally comes together. Once the crypto market shifts into full acceleration mode, there is no time to build systems, double-check accounts, or calmly think through scenarios. The people who succeed in those moments aren't reacting faster than everyone else. They're reacting less. They're executing plans that already exist. One of the biggest mistakes is assuming you'll figure it out when it happens. That mindset works in slow markets. It fails completely in fast ones. When XRP starts moving aggressively, information overload becomes extreme. Price alerts fire constantly. Social media fills with new targets every hour. Opinions conflict, emotions escalate. In that environment, even experienced participants can freeze or make impulsive decisions that contradict everything they believed beforehand. This is why clarity beats confidence. Confidence can disappear under pressure. Clarity holds. Clarity comes from understanding not just what you hold, but how it behaves under stress. XRP is no longer just another speculative asset. It sits at the intersection of retail speculation, institutional infrastructure, regulatory frameworks, and enterprise liquidity. That combination gives it strength, but it also changes how price action unfolds when pressure builds. At that point, the market stops being fair and becomes efficient. Efficiency doesn't care about expectations. It only cares about clearing imbalances as quickly as possible. If that means skipping price levels, it will. If that means prioritizing large counterparties, it will. The market's job isn't to reward patience. It's to match supply and demand. That's why the idea of a single perfect exit is fragile. It assumes order during disorder. A more resilient approach is adaptability, being able to act in parts, being able to wait when conditions aren't favorable. Being able to accept that sometimes the smartest move is doing nothing while chaos burns itself out. Another overlooked aspect is emotional fatigue. Holding through years of uncertainty builds pressure. When release finally arrives, people want closure. They want resolution. That desire can push rushed decisions just to feel relief. Markets are very good at exploiting that emotional release. The irony is that the calmest decisions often come after the biggest moves, not during them. Volatility eventually fades. Liquidity eventually returns. The question is whether you still have options when that happens. Panic trades remove optionality. Patient execution preserves it. There's also an identity shift when numbers grow large. An XRP position that once felt abstract suddenly represents real-life changes. That can trigger fear as much as greed. Fear of losing it, fear of making the wrong choice, fear of missing the next move. Those fears don't cancel each other, they stack. Without a framework, they can paralyze action. This is where separating belief from behavior matters. You can believe in XRP's long-term role in blockchain and global payments while acknowledging that markets overshoot, retrace, and redistribute. Those cycles don't invalidate the thesis. They're part of how value moves. The quiet truth is that not everyone who holds through a bull cycle benefits from it. Some sell too early, some sell too late, some never sell at all because they're waiting for a future that keeps moving. The difference is rarely intelligence or conviction, it's preparation. Preparation doesn't mean predicting prices. It means understanding scenarios. What if liquidity dries up? What if exchanges struggle? What if volatility forces uncomfortable choices? Asking those questions early removes their power later. You don't need to win every part of the move. You don't need perfect timing. You need to avoid catastrophic mistakes. Markets forgive missed upside far more easily than forced errors. As XRP matures, its behavior during stress will increasingly resemble traditional finance. Pauses, repricing, reallocation, not smooth exits. People expecting friction will be far less surprised than those expecting perfection. None of this removes optimism. It strengthens it. Understanding complexity turns hope into strategy and strategy into usable outcomes. The next major XRP move won't be remembered only for price. It will be remembered for who managed it well. The chart will look the same for everyone. The results will not. At the end of the day, the goal isn't just holding the right asset. It's navigating the moment when holding turns into decision-making. That's where outcomes change. And that's why preparation isn't pessimism. It's respect for the market, for your patience, and for the time you've already invested. You've already done the hardest part by holding through uncertainty, doubt, and long stretches where nothing seemed to move. That patience matters. But patience alone isn't enough when the market shifts from quiet to chaotic. The final stretch of any major move is rarely decided by conviction. It's decided by execution. And execution suffers when it's improvised under pressure. Too many people assume they'll simply react when the moment arrives. That approach works when markets are slow and liquid. It breaks down when volatility compresses time and decisions stack on top of each other. When XRP begins moving aggressively, the environment will be noisy. Alerts will fire nonstop. Commentary will escalate. Targets will change daily. In that setting, even experienced participants can lose their footing. That's why clarity is more durable than confidence. Confidence depends on conditions staying comfortable. Clarity survives discomfort. Clarity comes from understanding how XRP behaves when liquidity tightens, when institutions dominate flow, and when public markets lag behind private positioning. XRP is uniquely positioned at the crossroads of blockchain infrastructure, enterprise usage, regulation, and retail speculation. That makes it powerful, but it also makes it behave differently when stress hits. At that stage, the market stops catering to expectations. It becomes ruthlessly efficient. It clears imbalances as fast as possible. If that requires skipping price levels, it will. If it requires favoring size and negotiated liquidity, it will. The market doesn't exist to reward patience or belief. It exists to resolve pressure. That's why relying on a single perfect exit idea is fragile. It assumes order in a moment defined by disorder. A more resilient approach is flexibility, acting in parts, waiting when conditions aren't favorable, accepting that sometimes the smartest decision is not selling at all, but allowing volatility to exhaust itself before acting. Emotional fatigue plays a larger role here than most admit. Years of holding create internal pressure. When release finally comes, many people rush decisions simply to feel relief. Markets are exceptionally good at exploiting that impulse. The calmest decisions often come after the biggest moves, not during them. Liquidity eventually returns. Volatility eventually fades. What matters is whether you still have options when that happens. Panic removes options. Patience preserves them. As numbers grow larger, identity shifts. What once felt abstract suddenly feels life-changing. Fear stacks on top of greed. Fear of losing gains. Fear of missing more upside. Fear of making the wrong move. Without structure, those fears can freeze action entirely. Separating belief from behavior becomes essential. You can believe deeply in XRP's long-term role while acknowledging that markets overshoot, retrace, and redistribute. Those cycles don't invalidate the thesis. They're how value moves through systems. The uncomfortable truth is that not everyone who holds through a major rally benefits from it. Some exit too early, some too late, some never exit at all. The difference is rarely intelligence. It's preparation. Preparation isn't about predicting prices. It's about understanding scenarios. What if liquidity dries up? What if exchanges struggle? What if volatility forces uncomfortable timing? Asking those questions early removes their power later. You don't need perfect execution. You need to avoid irreversible mistakes. Markets forgive missed upside far more easily than forced errors. As XRP matures, its behavior under stress will increasingly resemble traditional finance. Pauses, repricing, reallocation, not smooth, continuous exits. Those who expect friction will be far less surprised than those expecting simplicity. This understanding doesn't weaken optimism, it strengthens it. Complexity turns hope into strategy. Here on Line of Crypto, the focus has always been on seeing the market clearly, not emotionally. The next major XRP move won't be remembered only for how high price action went. It will be remembered for who managed it well. The chart will look the same for everyone. The outcomes will not. At the end of the day, the goal isn't just holding the right asset, it's navigating the moment when holding turns into decision-making. That's where most wealth stories are quietly rewritten. Preparation isn't pessimism. It's respect for the market, for your time, and for the conviction you've already shown.